With the markets, Alli, we got about a 2% little gut check here in the S&P 500. Maybe no big deal after, we got this rally of as much as 17%, but it seems to show how delicate the path is, perhaps, to a favorable economic outcome. We got 2 days of relief when we thought maybe the Fed was going to pause. They got a couple days of pretty sturdy economic numbers, and now we're worried again. So where does that leave you heading into year end with your stance on the markets and discussions with clients?
Wow, there's a lot in there, Mike. The last week has been a series of just days of whiplash, right? I mean, ultimately, we have this seesaw where trading activity, price action is whipsawing between which is going to go down further and farther, inflation or growth. So you have a day in which China feels like it's going to be reopening. The growth story wins, the market goes up. You get good inflation news, and then that dominates. I'm thrilled that we've had the recovery that we have. I think, as all your guests have seen, we certainly see more medium and near-term risks than we do upside. And largely that's because if you think about where we are and what the expectations are for earnings, for growth, for inflation, for the path of interest rates in 2023, and then you contrast that to a market that is trading from a multiple perspective above its historical high, that just doesn't jive. So I think from a market's perspective, December, we're not expecting a lot of new news, but we are expecting some tax loss harvesting selling, and we're expecting a lot of institutional money to probably stay on the sidelines and wait for the January reset. So this is a time to be thoughtful about how you're positioned, how much cash you have, where you want to be going into next year, and what the expectations are, probably not to take additional risk or be too cute.
And what about this rally that we've seen in bonds? I mean, a lot of folks seem to have listened to the observations people have been making about you got some relatively safe yield to lock in. Where do bonds sit right now in terms of the risk reward?
So I think for the first time in, 14 years, it's pretty high up on the scale. And so for people like me and my clients, the ability to be able to incorporate something into a diversified portfolio beyond equities is definitely pretty exciting. We have taken some short-term high-grade credit on the table, but we're still a little early, I think, to really completely lean into that trade, and a little too uncomfortable with what's ahead of us to get really, truly into upper tier high yield. But I think that the exciting part of 2023, even if we have a rocky first or second quarter, which we are expecting, is that for the first time since I ran a derivative desk, during the financial crisis, we are going to have the ability to invest in bonds in certain parts of the equity market and in many parts of the private market in a really fundamental way once the story gets back to fundamentals and not just technical price action. And that's pretty exciting.